Wall Street loves to sell you a very dangerous phrase: buy and hold. They tell you to buy a good stock, put it in your retirement account, ignore it, and let time do the rest. But what happens when you ignore a stock for 5 years and wake up to find it lost 40% of its value? Buy and hold is not an investment strategy. For most retail investors, it is just an excuse for neglect. You hold on to losers because you do not have a rule that tells you when to let go. Today, we open the 6th phase of our risk architecture: the low attention segment. This is the quiet engine of your portfolio. In the next 3 minutes, I will show you how to hold long-term investments without letting them become permanent, bleeding liabilities. So, what exactly is a low attention holding, and how is it different from your core compounders? This is the exact point where retail investors break their portfolios. They cross-contaminate. Your core segment is your heavy engine. It is built for structural growth, and you hold it unconditionally through brutal drawdowns. You expect it to be volatile. The low attention segment is the complete opposite. It is your cognitive firewall. Its entire purpose is reliability, through neglect. We populate this bucket with assets that have a simple rationale and relatively low volatility. Here is the structural difference in how you manage them. You only sell a core asset if the underlying business fundamentally breaks. But the low attention segment has a strict neglect tolerance rule. If an asset in this bucket starts making you nervous, if it forces you to log into your account and ask, "Should I do something about this?" it is instantly evicted. Inactivity here is a feature, not a failure. If you permit high volatility in your low attention holdings, you will drain the mental bandwidth you need to manage your active, tactical trades. You must respect the boundary. Now you know what belongs in this bucket. But understand this: low attention does not mean zero rules. In a professional architecture, deliberate simplicity requires brutal constraints. You cannot just dump random amounts of capital into this segment and walk away. This bucket requires a strict mathematical ceiling, a hard allocation limit. Why? To protect you from yourself. If one of these quiet assets suddenly doubles in value, your portfolio is no longer balanced. It is dangerously concentrated. You need automated rebalancing triggers. The system must dictate the boundaries, not your emotions. By setting strict allocation rules, you eliminate the fatal retail urge to tinker. But I am not going to give you generic percentages or random numbers here on YouTube. Guessing the math is exactly how amateurs blow up a good strategy. Concepts do not generate wealth. Execution does. I have given you the architectural theory of the 6-segment portfolio, but the actual mechanics, the exact allocation limits, the rebalancing triggers, and the system rules are not for casual viewing. They belong in a structured operating system. If you are ready to stop managing your retirement like a casino and start treating it like an engineering problem, you need the math. Look at the first link in the description and the pinned comment below. Download the complete 6-segment architecture blueprint. Stop reacting to the market like an amateur. Build your framework. Engineer your wealth. The theory ends here. The real work begins in the blueprint.